Welcome everybody. For those of you who don't know me, my name is Ashley Davidson and I'm a partner here at Pitcher Partners. Like many of you on this webinar, as a partner, I'm a business owner and I see myself as a business owner. Like many business owners of the clients of mine, the proprietors are bringing education, experience, relationships, leadership, and effort every single day I come into the office to try to run a profitable business. The factors that I just spoke about, they're not distinguishable in the professional services industry. They're the same in every industry, whether that's, I'll go through my client list, whether that's a property developer, a fashion retailer, a software engineer, a shoe care manufacturer, an office furniture wholesaler, a grass seed farmer. They all have owners who are putting in every single day. However, despite the fact that those efforts are not distinguishable and all of those businesses owners are bringing their own contribution of IP to their businesses, the ATO has sought to single out the professional service industry and expect us to treat profits in a particular way. Today, we're going to go through the latest iteration, Practical Compliance Guide 2021 Draft 2, Allocation of Professional Firm Profits ATO Compliance Approach. This is not new legislation that's passed through Houses of Parliament. It's not an interpretation of law that's gone through the stress of a court and a decision. It's not even a public ruling binding on the Commissioner. This is administrative guidance as to the ATO's proposed compliance approach in respect of what I think is the dark art of interpretation of Part 4A, the general anti-avoidance provisions. And while the ATO might describe this as administrative guidance, I'd suggest that these are the words contained in this document. Reviews are likely to be commenced as a matter of priority. Cases may proceed direct to audit. We are likely to use formal powers for information gathering. And that's in circumstances where previous guidance and behaviours that was considered acceptable and fully compliant with the law is now unacceptable. To me, that's far from guidance. I think the threat of audit with what I would suggest is very little legislative basis, if anything, is closer to bullying. We don't know. This may well be the ultimate bluff, but the ATO certainly knows that the advisor community is not in a position to be telling their clients to take on the ATO, and certainly is unlikely they'll be doing that. As Mark Northeast and Leo Gusenfeder will outline shortly, this creeping attack on the service industry has been happening for a while. We had, back in 2000, the Personal Services Income legislation, which set up the concept of a personal service business. We thought that was about the end, but it certainly hasn't been. The most significant ongoing guidance, which Mark will refer to, happened in 2007 with the service trust changes, and then more recently, the original income guidance in 2015. I'm sure many of you are aware of that. I was surprised when that 2015 guidance came out that the ATO would seek to single out a certain type of business. But in the end, I think most of us got comfortable with it and decided it was reasonable. But this new practice guidance, the ATO has taken a great leap forward from that position. The implications that Mark and Leo will discuss impact on very legally set up, properly managed, in some cases quite historical structures. Therefore, unless we get some serious movement in the ATO thinking, this is something that we're all going to need to be well aware of as we go into 2022. Mark Northeast, who'll start off the discussion, has been a provider of taxation and commercial advice into the professional practice industry for many years, and I'm sure is known very well to many of you. Leo Gusenfeder, who he will pass on to, is a leader within our taxation technical team in the tax advisory group at Pitcher Partners. Now, don't hold this against him, but we brought Leo from the dark side. He was at the ATO for a while and in fact spent some time in this professional services team. So he has a little bit of an idea of the thought process. At the end of the session, I'll moderate any questions that might come through. Please use the Q&A function, not the chat function, the Q&A function at the bottom of the screen if you'd like to ask any questions, and we'll talk about those at the end. So, Mark, over to you.
Thanks, Ash, and good afternoon. Leo, if we could just have the next slide, please. Thank you. So what we're looking at today is some background to the latest guidelines and what the conditions are that if we end up with these guidelines that you need to satisfy to be able to access them. Then Leo will be talking about the new benchmark or traffic light scoring system, if you can get into the guidelines. We'll touch on what's been done in terms of feedback to the tax office. And finally, we'll finish off with a few implications or next steps for your practice. So if I can just go back in history, next slide, please, Leon, thank you. In 1991, we got IT 2639, and that effectively told you where your practice income was from personal exertion, which you could not split, or when it was business income, which you could split. Going forward, from 2004 onwards, there was a lot more flexibility with structures that professionals could go into. 2005 to 2007, we saw the tightening up of the service trust rules. We saw easier access to the CGT small business concessions for ease of restructuring, better access to superannuation, and also some tightening up of bankruptcy law changes, which made restructuring of your professional practice perhaps more of a priority. As Ash mentioned, 2015, we got the original guidelines. We've had a couple of more movements since then. And 2021, we've got some draft replacement guidelines. Next slide, please, Leo. Thank you. So back to 1991, when life was pretty simple. In 1991, the Commissioner issued IT 2639 and said that effectively, if you've got business income, you can split it. But if it's personal services or personal exertion income, you can't split it. And IT 2639 provided a couple of tests, but the simplest test was that if I, as a practitioner owner, had as many fee earner owners as fee earner employees, so it could just be me with one fee earner employee, not an administration or a PA, but me and as an accountant owner and then one other owner, then I had business income and I could split it. And IT 2639 and the line between what is business income and what is, let's say, personal exertion income still exists today. Next slide, please, Leo. Fast forward a few years, and we had the tax office in 2007. From about 2002 to 2007, they were tightening up on the service trust rules. And what, in effect, that did, along with better ease of restructuring in terms of better access to CGT concessions, improvements in superannuation, tightening up of the bankruptcy rules, meant that if you squeeze the service trust entity too hard, then people started looking for opportunities with their practice entity and how they could restructure their practice entity to achieve some income splitting. Today, those service trust rules that they set up in 2007 are still there today. So very broadly speaking, you can get a 10% profit margin on what goes through your service trust. If you've got $1 million of costs going through your service trust, you can get $100,000 profit out of your service trust. Service trust income is still relevant when Leo comes to talk about the benchmarks later on that needs to be taken into account. But nothing in the rules that we get in 2021 or the draft rules the tax office have released change your allowable margin for your service trust. Next slide, please, Leo. So 2015, before 2015, and if I can go back to 2005 to 2011, the tax office did some analysis, and they found that in 2005, and it was mainly accounting and legal firms they were looking at, they found in 2005 only 7% of the accounting and legal firms they looked at had a non-individual partner, let's say a trustee partner. But by 2011, that figure had grown to 18%. So they could see a trend with the, let's say, the more flexibility that people or professionals had about their structures, that more and more, if we use the partnership example, that more and more, let's say, partners were no longer individuals, but trustee partners. And again, there was an increase in incorporated practices and trustee shareholders, for example. And from about 2012, the former Deputy Commissioner of Small Business, Michael Cranston, ran consultation from 2012 to 2015. And in 2015, we came up with what the original guidelines were, or what's now referred to as the suspended guidelines. Look, they were unsupported at law and they're discriminatory like the new guidelines, but access to them was relatively easy. You could access the original guidelines as long as you had business income. That wasn't personal exertion income. Going back to IT 2639, you had as many fee earners, as many fee earner employees as owners. It wasn't PSI under those PSI rules that Ash mentioned, the strict rules or the legislative rules that came in 2000. So first criteria to access them was you had business income. Second criteria to access the original guidelines, you had to have a legally effective structure. And the original guidelines referred to a partnership of discretionary trusts or a partnership of trustees, to be more correct, as a legally effective structure, and your documentation had to be in shape. And effectively, that was saying, for example, if you're an incorporated practice, then you had, in that case, you had your company documentation in place, or your documentation matched the legal shape of your practice. And so, next slide, please. Thanks, Leah. So with the original guidelines, they, as probably everyone knows, they gave you three choices which you could change on a year-by-year basis, and it was relatively simple to comply with them. So if my profit share from the practice was, let's say, 200,000, then I'd typically choose the 50-50 test. 100,000 goes into my tax return personally, and let's say 100,000 goes into a non-working spouse's tax return. At the other end of the scale, if my share of practice income was, say, $2 million, I'd typically choose the top employee level remuneration. If my top employee, broadly speaking, was on 300,000, there's 300,000 that went into my tax return personally, and 1.7 I could split. And those original guidelines still apply today. They still apply for the 2021 year. And when we touch on the transitional arrangements, they potentially still apply to some practitioners for the 22 financial year and the 23 financial year. We'll come back to that in a moment. If I could just go forward, the next slide, please, Leo. 2006, still good news. Michael Cranston, still the Deputy Commissioner for Small Business in the Tax Office. And in 2006, they've issued some administrative guidelines for non-goodwill practices. And those administrative guidelines, which still apply today, are to the effect that the tax office won't apply market value substitution rules when people come and go from no goodwill practices for nil or nominal consideration, or there's a merger or a takeover of practice done on arm's length terms. And then next slide, please, Leo. From about mid-2017, and it may be coincidence or it may not be, in May 2017, the Deputy Commissioner that was in charge of small business, Michael Cranston, you might recall that his children were up on alleged fraud charges. And from mid-2017, Michael Cranston resigned from the tax office after the ATO accused him of abusing his position. And then in late 2017, and it may or may not be coincidence, we got the tax office withdrawing or suspending, I should say, their original guidelines and saying that they wanted to review them. And as part of the consultation group with the tax office, from early 2018, we had the tax office saying to the professionals in that consultation group, we'd like to get your views and we'd like to know what to do, et cetera, to our faces. But behind the scenes, in what we didn't know about, then came along to the May 2018 budget, which I think was 11th of May 2018, and they introduced law, which meant in that case, no CGT, small business concessions for Everett assignments. So what the tax office were doing at that time, on the face, they were to the world, they were saying they were entering into consultation, but behind everyone's, without anyone's knowledge involved in that consultation, or at least outside the tax office and treasury, they were changing the rules. So in May 2018, what they did was take away the CGT, small business concessions for Everett assignments. And I suspect at that time they were flooded with private ruling requests for Everett assignments, and mainly from, it was my understanding, the big four accounting firms. And so what that created from May 2018 was different classes of partners. If I've done my Everett pre 11th of May 2018, I'm okay. I get the CGT small business concessions. And I'm okay if I'm not a partner and I join a partnership and I decide to join through, let's say, a discretionary trust structure after May 2018, because I'm not entering into any assignment, I'm just joining as a trustee partner. So I'm not impacted by these rules. But we ended up with a class of partners in professional practices who were still individual partners who had not entered into any assignments, who were impacted by these changes in that they couldn't then enter into, let's say, an Everett assignment after May 2018 without a CGT cost, because the CGT small business concessions have been taken away. So the start of a downhill slide with the tax office. And then next slide, please, Leo. Then what we got in, as you're aware, in March, after 3.5 years of really stuffing around, the tax office came out with PCG in March 2021 D2 in March 2021. And this PCG is, I guess, what we're talking about today. And the basis for this draft PCG is found in paragraph 8 of the PCG. And in paragraph 8, it says the Commissioner has a view that some part of a practitioner's income might be personal exertion income, even though the practice might derive business income. Now, that view is discriminatory because it only applies to professionals, and it's unsupported in law. In fact, if you go back to IT 2501 at paragraph 6 of that, you've got the Commissioner, maybe a different Commissioner in those days, but you've got the Commissioner on the public record saying in IT 2501 that regardless of how much effort you put in, and the words are how much or how little energy is devoted to the practice, that it's business income and it's wrong to say it's from personal exertion. And the Commissioner quotes that in IT 2501. So we've got the poor old Commissioner at odds with himself in PCG 2021 expressing a view compared to his previous ruling. The view expressed in PCG 2021 is unsupported at law and it's discriminatory. It's a bit like saying that I have a view that people who drive red cars drive too fast, therefore their speed limit should be restricted. That's also a discriminatory and unsupported view at law. The other complaints about PCG 2021, it introduces more complexity, as you'll see when Leo gets onto his slides. It gives you less flexibility on profit allocation or income splitting, to put it bluntly. It's still in draft form. It may change. You don't have to follow it, but if you don't follow it, or you're outside the rules, you become high priority for a tax office visit. And it applies prima facie it doesn't apply for the current financial year, and prima facie it applies from 1 July 2021, unless you're in the transitional arrangements. So these transitional arrangements are even problematic. So if you're in the transitional rules, you still get 21, 22 and 23 under the old tax office guidelines. Good luck trying to find those guidelines on on the tax office website. They took them down about 3 years ago, and unless you've got them from previously, and we can supply them if you need them, you won't find them on the tax office website. But if you come under the transitional arrangements, you can still apply the old, more flexible and fairer rules. So to come under the transitional arrangements, you've had to have your arrangements personally in place pre-December 2017, the first condition. The second condition, you can't fail any of what they call the Gateway 2 factors, which I'll come to in a minute. And the third condition is your arrangement's got to be commercially driven, which will normally be the case. So you can choose if you're, let's say, a December 2017 restructured practitioner owner, to continue to apply the old rules in 21, 22 and 23. But if your practice is restructured since December 2017, or you've been admitted to practice since December 2017, then as things stand today, you've got to apply, well, you don't have to, but you fall within PCG 21 or the new guidelines from 1 July 2021. Next slide, please, Leo. So before looking at how much income you can split or how you allocate your profit, you've got to be able to qualify to get into PCG, the new guidelines. And the tax office have really thrown everything they can think of in here. As you go through the PCG, there's at least 30 factors that you have to satisfy. Some of them are easy to satisfy, some of them more difficult, to get within the new guidelines. And the trouble is that you've got professionals saying these guidelines are unsupported and they're discriminatory on one side, and you've got the tax office on the other side thinking they're doing you a favour by giving you these guidelines, which are discriminatory or unfair, and saying, but hang on, to get into them, you've got to pass at least 30 factors. So to run through some of those factors quickly. First of all, you've got to be an individual professional practitioner, which means you've got to provide professional services or be actively involved in the management of a professional firm. Secondly, you've got to hold a legal or beneficial interest in the firm, either yourself or one of your associated entities. And thirdly, what's a little bit more controversial, is you've got to be an equity holder with full rights regarding voting, management and income. And we'll get on to fixed draw participants in a minute, which I believe are excluded from the guidelines going forward. The firm has got to be deriving business income. It's got to be a legally effective structure. Plus, you've also got to satisfy what's called Gateway 1, Gateway 2 and other compliance issues. So if I could just go to the next slide and talk about the distinction that's now come up between equity and non-equity participants. So I'm using partners in a partnership as an example. Previously, under the old guidelines, all you had to have was a legal and beneficial interest in the firm. And I would argue that a fixed draw partner, or a salary partner as they're sometimes called, had a legal or beneficial interest in the firm to the extent of their partnership draw or their partnership interest. Now you've got to have both a legal and beneficial, under the new guidelines, a legal and beneficial interest in the firm, and you've got to be an equity holder with full rights regarding voting, management and income. I see this as a retention issue for professional practices, because practices that have, let's say, fixed draw partners, salary partners, in terms of attracting and retaining those professionals who may be key contributors to the practice, we may have to, going forward, revisit whether they should stay fixed draw or whether or not there's some sort of equity arrangement we can give them. The tax office say they engage the ATO. I personally find that hard to see is very helpful. But there's just something there to watch out for our non-equity participants going forward. Next slide, please, Leo. So I've got my equity participant, and then the next thing I've got to get through is what's called Gateway 1. And there's 4 elements to Gateway 1, and that is the structure or restructure must have a general commercial basis. The way in which profits are distributed must be on a commercial basis. Arrangements must be appropriately documented, and the documentations, the legal documentation's effectively got to be consistent with the economic substance. So to go on to the next slide, please, Leo. So what the tax office say is your structure, your professional practice structure, has got to have a genuine commercial basis. And that is, does it, to shortcut it, does it enhance, assist or improve your income or profits? Or are there other commercial benefits? And next slide, please, Leo. So typically with a professional practice, your structure, I think, should be attractive to attract and retain your key people. Income and assets should be protected. It should offer distribution flexibility, and it should be relatively easy to get in and out of your professional practice. And if we can just go to the next slide, Leo, and then working backwards, if I can get distribution flexibility, and if I can get a certain amount of income to the right-hand slot, part of this slide, which is bank account 2, that income is substantially protected from an income and asset protection point of view. So the more I can get not coming through my own name personally, in terms of a catastrophe situation under the bankruptcy law, the better is my asset and income protection position. And the better is my asset and income protection position for my distribution flexibility, the more attractive my practice is for attracting and retaining the best people. So if we could just go to the next slide, please, Leon. I won't only spend a minute on this slide. If the tax office come and look at your structure, these are the sorts of things that they'll be looking for. They'll be looking to see whether it's complex or simple. The more complex, the more questions they'll have. Are things set up just to gain a tax advantage? Do you get a different tax and economic result? Is your practice operating on commercial and non-commercial terms? And there is a gap between the legal form and the substance, and that'll come back mainly to documentation. In terms of Gateway 1, it's not only your structure that the tax office look at to be commercial, it's your profit distribution. And there is a bit of a trap, I think, in just going to the benchmarks, which we'll come to later on. But before we get to the benchmarks, the tax office are looking to see effectively that the remuneration that the practitioner owner gets is commercial in itself before we as a gateway, before we get to the traffic lights system later on. And Leon, if we just skip through to the next slide after this one as well, we just touch on documentation. All I really want to say on documentation is when the tax office come and look at you, often documentation's all you've got, and the tax office are looking for consistency with your stated legal structure and your documentation. For example, if you said you're an incorporated practice, they'd be looking for your business cards and your sign-offs to be in the name of principals or directors, for example. If you had trustee shareholders of an incorporated practice, they'd be looking to see that the money flows to the practice to a bank account set up in the trustee shareholder, for example. So just a simple message with that from documentation from the tax office point of view is the documentation is consistent with your stated practice structure. And effectively the same on the next slide for form and substance. Again, you align your stated your documentation to your stated legal structure. I'd just like to quickly touch on two more things. I'd like to go to Gateway 2. So if you get through Gateway 1, and in most cases, I believe you'll get through Gateway 1, your structure will be commercially based, and your distributions should also have a commercial to the individual practitioner. Owners should also have a commercial element about them. And if your documentation's in place, then you'll get through Gateway 1. Having got through Gateway 1, you've got to get through Gateway 2. And Gateway 2 is the high risk factors. Gateway 2 is important in two senses. If you fail Gateway 2, even after getting through Gateway 1, you don't get into the PCG, and then you become high risk and a higher priority for a visit. And also, if you don't get through Gateway 2, you can't get the 2-year transitional extension to 30th of June 2023 for those December 2017 arrangements. So Gateway 2 talks about, as examples, 5 different things. The first one's financing arrangements. And this is something that I used to think was relatively harmless. If, for example, if I'm a partner individually and I sell my practice interest to a discretionary trust for $100,000, my discretionary trust goes to the bank, borrows $100,000, and then pays interest, tax-deductible interest to the bank because it's bought my practice interest, and I use the $100,000 to pay off my home loan. I've effectively turned non-tax deductible debt of $100,000 into tax-deductible debt. That's apparently that is what the tax office says, an example of a high-risk feature, which I always thought was pretty vanilla. If I've got that situation under Gateway 2, I don't get into these guidelines. The second point, exploitation the difference between accounting standards and tax law. What some practices did in the past, they'd start off as a partnership of individuals, and let's say they'd sell that practice for $10 million to a company, an incorporated practice. So the opening balance sheet of that incorporated practice would be debit goodwill, $10 million, and credit loan back to the individual partners or the partnership of $10 million. And then there'd be an impairment of goodwill of $10 million, let's say $1 million a year over 10 years. And that would mean that incorporated practice would have low or no accounting profit. It'd still have tax profit, still be paying tax at 30 cents in the dollar. But because it wouldn't have any accounting profit, there'd be no top-up tax, and the first $10 million earned would go back to repay the partners for selling a practice across. And that's an example of creating or exploiting differences between accounting and taxable income. The third dot point, arrangements different from Everett and Gellens cases. I've never seen it, but apparently the tax office has seen it, cases where fixed draw partners were entering into Everett assignments, and they don't like that. On a similar vein, in terms of incorporated practices and unit trusts, where they see multiple classes of shares and units held by people who don't have voting rights, they call non-equity holders, they see that as a high-risk feature. And finally, they also see a high-risk feature if an arrangement is covered by a taxpayer alert. For example, there's a taxpayer alert on dividend excess shares. Whether or not it applies to your practice, it again is another exercise. But if the tax office think it covers what you're doing in your practice and you've got dividend excess shares, then that's a high risk factor under Gateway 2. And you don't, if you want to access these new guidelines, you don't get into them. Next slide, please, Leo. So even if you do get through Gateway 1 and Gateway 2, the tax office say that, well, even if you've got through, bad luck, you don't access these new guidelines should you want to, if you've got one of these factors. And for example, if I go to the bottom one on the left-hand slide, if I'm a late lodger of my tax returns, it's got nothing to do with income splitting, but it means that the tax office won't allow me to access the new guidelines. And then if I go, for example, to the bottom dot point on the right-hand side, that's talking about non-tax advantages which are dependent on taxable income. If, for example, my taxable income is what the tax office would call artificially low, and because it's artificially low, I don't have to pay what might otherwise be the required level of, let's say, child support if there's been a marriage breakdown. That's an example of a non-tax advantage which is dependent on taxable income. So if the tax office see one of these factors, they won't also allow you into the guidelines. Next slide, please, Leo. So assuming that you can get through all of that and you're into the guidelines, what we do now have is, which Leo will talk about, is a traffic light system where the tax office is combining either one benchmark, two benchmarks or three benchmarks to give you a red, green or amber rating. If you're green, they'll generally leave you alone unless there's some other reason to come and see you. If you're amber, they say they're likely to come and see you. And if you're red, you become a priority to the tax office. There's no logic to the traffic light system as compared to the stated logic for the guidelines that some part of your income from personal exertion, there's they're very blunt. The benchmarks are very blunt instruments, which I'll now hand over to Leo to talk about.
Thanks, Mark, and good afternoon to all those listening in today. Hope you're all doing well. There's no doubt busy time of the year. So picking up where Mark left off, I'll provide an overview of the ATO's risk assessment scoring table, which you can self-assess your risk once you've got through all those gateways which Mark touched on. And as Mark indicated, the draft PCG says that this is really just ATO's, how they can allocate their compliance resources to considering the way these practitioners are remunerated in relation to their professional firms. And they are applied on an individual rather than firm basis, so practitioner by practitioner. Now, in this table, the first factor looks at what percentage of the profit entitlement for the year is returned in the hands of that individual professional practitioner. Where it's 50% or less, you sort of get placed into this high risk territory. 75% or more, you're more in the lower risk territory. The second factor looks to the effective tax rate for the year on that profit entitlement in the hands of collectively the practitioner and all associates, anyone who takes a share of that. So having an effective tax rate of above 35 is sort of seen to be lower risk, or 25% or less is more on the higher risk. And noting 25% is a lower corporate tax rate from 1 July. The third factor, and it's interesting, say to be optional, we'll touch on that more, it actually requires remuneration. Sorry, the third factor actually is what is the amount received compared to the practitioner's commercial benchmark for the services provided to the firm. And you need to somehow show a greater than 200% to get the lowest risk possible, but less than 70% is more in the high risk zone. And we'll go a bit more in detail on all these shortly. So as Mark mentioned, under this framework, you add up your total score and it'll sort of dictate whether you're in a green, amber or red zone, indicating low, moderate or high risk, this traffic light system. Obviously the scoring system is such that the lower the risk, the better. So if you're using the first two benchmarks, you get a score between 2 and 12, and if you use all three, between 3 and 18. And to reiterate the issue about using the third factor, you can see on this slide that it's stated in the footnote, and this is verbatim from the PCG, that in recognition of the difficulty of finding a comparable benchmark, you only receive a score based on the first two factors. It says it's stated to be optional, so potentially you might not have to use it. And we're not 100% sure if that means you can disregard entirely, even if you do have an easily established benchmark. If you have it there, can you choose not to? So the PCG is somewhat vague on this point, and just want to make two comments on that. The first is that the PCG has 7 sort of worked examples. Now, the first 6 don't consider the third risk factor at all, for the stated reason that it cannot be accurately determined in those cases. Now, the last example in the PCG, which does consider this third factor, actually takes the IPP, that individual professional practitioner, out of the green zone and into the amber zone. So this begs the question, why would that individual in that example go to the trouble of getting that data to apply the third factor if they were already in the green zone and stated to be optional? So perhaps this is not the greatest example, and it might be reworked in the final product. It would be more useful to show someone using it to get themselves, let's say, out of the red and back into the green rather than the other way around. Now, the second point is, while it's not stated in the PCG, you sort of wonder if the amount the practitioner returns in their own name is relatively small, let's say nil. Even if no one can accurately determine or quantify that commercial benchmark for their services, when you're going to be pretty certain that nil is less than 70% of whatever that is. So does that question mark, does that automatically give you a 6 on that third factor, even if you can't establish what the commercial remuneration is, and they'll probably take you into a red zone? Or can you just simply say, oh, look, it's optional and I choose not to use it? And it's not crystal clear what the answer to that is at the moment. Now, just going back to this table, I just want to touch on the interactions between the factors. So you can see that even if a high score is achieved on factor 1, score of 6, you can still be a low risk if you get a score of 1 on factor 2. That'll take you to a total of 7, which puts you on the top end of the green zone. So that could be a case where you return little in your own name, but overall the income's taxed at more than 40% overall, let's say in the hands of another individual. However, it's hard to see this applying in the reverse scenario. For example, if you get a score of 5 or 6 on the second factor because of a low effective tax rate of, let's say, 25% or less, you need to somehow get a very low score on the first factor, meaning you have to return, let's say, over 75 or 90% of the profit in the hands of the practitioner. So it doesn't seem very unlikely that such large proportions will be returned in the individual's own name, and you'll still achieve a lower effective tax rate. So you only really see this as being relevant maybe with smaller practices or lower profit years, where you could get a lot returned in the individual's own name, but a low effective tax rate at the same time. So question whether those sort of practices are high on the ATO's radar anyway. Now, one thing to note is that the PCG provides that if 100% of the profit share is returned in the individual practitioner's own name, then you're automatically green, which is obviously a sensible scenario, because how could you be splitting, be a risk of Part 4A applying for alienating your income where you return 100% of it in your own name. So that might cover these situations where you can't achieve high effective tax rates because you've got low amounts of profit. If all of it goes to the individual, then you're going to automatically be seen as low risk. And lastly, note the interaction with the third factor. If I go back to the table on the traffic light system, if you get a score of 7 after the first 2, getting a score of 4 brings you out of the green zone if you use all 3, which can be the case where the practitioner gets exactly 100% of their commercial benchmark. Now, if you're in the red zone and you get a score of 9 after using the first 2 factors, you need a score of 1 on the third factor to get back into the green, which means returning more than 200% of your commercial remuneration in your own name. And you have to question whether this is a realistic score that anyone can achieve, particularly because the practitioner's not going to be returning anywhere close to 100% of their profit entitlement to be in the red zone in the first place. So as Mark touched on, what it means to be in each zone, green zone, sort of a low risk of ATO dedicating their resources to reviewing those arrangements, only in exceptional circumstances. Amber, there might be some further analysis to understand the situation better, and red, likely to be reviewed with a possible audit and use of formal information gathering powers as stated in the PCG. Now, before going through some examples, just want to cover a bit more detail about make some comments on each of the factors. So the first factor regarding the percent of income returned in the practitioner's own name. The first to note is that it includes entitlements to profit from all entities that comprise the firm, which could be, let's say, a main partnership or main entity, a service trust, maybe another associated entity like a financing trust, suggesting that the alienation of any of these profits made under any of these arrangements, including complying service entity arrangements, could place a practitioner at higher risk, which immediately jumps out as being inconsistent with the premise behind the whole PCG in the first place, being that Part 4A can apply where one enters into arrangements to alienate income, which is supposedly from their personal exertion. If the service entity arrangement is commercial and complies with existing guidance, the profit should represent something other than income from personal exertion, maybe return on assets or from other kind of services performed by the service entity, not necessarily by the individual practitioner. But as it stands, the ATO's scoring system is based on profits of all entities collectively. Now, on the second factor, we'll look at profit from all the service entity, all entities including the service entities. And the numerator for the effective tax rate is the greater of 2 amounts, which is favourable, as we'll show in an example. It allows the practitioner to pick the result that gives the highest effective tax rate. So on the left-hand side, you look at the total tax that is basically actually paid, assuming no other sources of income by the practitioner. So it's effectively taking it from if that was your only income from $1. And on the right-hand side, which generally gives you a high rate, looks at what tax would be paid if you ignored other amounts. And yeah, we'll go through this an example to sort of show how this works. And one interesting point to note about this is that the effective tax rate is based on the total tax paid regardless of which entity pays it. So if you recall, the suspended sort of be low risk under the old suspended guidelines, but that required both the individual practitioner and the individual and the associates collectively paying more than 30% tax on the firm's profits. Under this risk factor, the practitioner could still pay 0% tax individually, but you could still get a low risk score under this factor if someone else paid a lot of tax. So it doesn't actually focus on the tax rate of the individual practitioner personally. And for the third factor, if one does use it, PCG sets out ways one might establish an appropriate benchmark, which looks to employees in the firm who perform commensurate duties and have commensurate levels of responsibility. Also, you can find a benchmark in a comparable firm or relevant industry benchmarks if available. Now, realistically, employees might rarely, if ever, perform the same duties and have the same responsibilities as a principal, particularly when it comes to some of the more high-level management and involvement in business development and strategic direction setting of the firm. And the PCG recognises this and suggests you can adjust this, adjust the remuneration of a more senior employee and take into account various factors where there's differences between that employee and the practitioner's actual duties. And they list 11 factors that could be relevant in making this adjustment. So definitely not an easy exercise. Also, the PCG recognises that all components of remuneration are included, which include the whole package, super and fringe benefits, not just gross salary. And also, if this is done, it should be reviewed annually, and it's something that can be established with an employment agency consistent with the PCG. So just working through, go through three examples, what I think is some basic examples just to demonstrate how this works. So the first one, we've got $500,000 of profits in total coming from the firm, $450,000 from the main entity and $50,000 from the service trust. And let's say all those come through trust controlled by the individual partner or practitioner. Now, in this case, what the result we get is actually we're in the amber zone, because this 50-50 split also results in a 35% effective tax rate. And here we've assumed the individual was already on the top tax rate before this profit distribution. So 50-50 split gets you a risk score of 5 on the first factor, and the 35% effective tax rate gets you a risk score of 3 on the second factor. And both of these just happen to be on the very top of the range in that risk scoring table. And it's interesting that that's the case, that exactly halfway between the top marginal tax rate and the lower corporate tax rate from next year gets you just on the edge, the very top of the range on the risk factor 2. And when you compare this result to the suspended guidelines, under those, the practitioner would clearly be seen as lower risk because they returned 50%, so they passed that one, and they also had have an effective tax rate of well over 30%, in this case 35%. So we can see how the updated guidelines, this PCG, have effectively shifted the goalpost somewhat. And Mark touched on the transitional arrangements already, and potentially that maybe the old guidelines can still be relied on in the next 2 income years. So what could be done about this? I mean, simply, well, if you just change the distribution by $1, suddenly you get a risk score of 6, and then now you're sort of well into the green zone, because now you're just over 50% on risk factor 1, and you're just over 35% effective tax rate on risk factor 2, and they both give you a lower score. But one thing to note is that if the practitioner was a bit less wealthy and had no other sources of income, the effective tax rate on their 250,000 share would be much lower than would result in a much lower effective tax rate overall of 35%. So you'll find in that situation, the practitioner would actually be in the red zone if they had a 50-50 split. as the effective tax rate overall drops to around 29%. And you would need to change the splits to somewhere around 60-40 between the individual and the corporate to get back in the green zone. So this might be, again, seen as discriminatory against perhaps some younger or less wealthy practitioners who don't have other sources of income. I mean, alternatively, you might look to distribute to a non-corporate who will obviously pay higher tax than the 25% rate to get into the green zone rather than splitting with the corporate. Now, with the second example, what we have here is a $575,000 total share between the main entity and the service entity. And the way that the profits are distributed is 100% to the practitioner's spouse and none to the practitioner. So this might be, for example, done for asset protection reasons if they don't want amounts in their own name. And we've heard anecdotally some firms don't allow that practitioner to be a beneficiary of the trustee partner, so they can't actually distribute to them. So in this case, we get, assuming each, the IPP and the spouse both have no other income, you actually fall into the amber zone. You get a risk score of 6 on the first factor and no tax return in individual practitioner's own name and 2 on the second factor. You can't get 1 on the second factor just because simply there's not enough income to get a 40% effective tax rate. Based on the current marginal tax rates, you actually need $588,660 to achieve a 40% average tax rate. So there's simply not enough taxable income here to get that lower risk score. And that actually becomes over $768,000 from 1 July 2024 when the next lot of tax cuts come in. So the result here is that we're in the amber zone, despite the fact that basically you're paying the same amount of tax as you would if all of the income was returned in the name of the individual practitioner. It's gone to another individual here. And also question, well, let's say, can we just choose to ignore the third factor, or will the ATO come along and say, well, I'm going to apply a risk score of 6 for that one because you return 0% in your own name, which is clearly going to be less than your whatever benchmark is, no matter what it is. So to get out of the amber zone, we can't simply make an easy tweak like the first example by changing by $1, for example. You need to get over 25% in the individual's own name to lower that score from a 6 to a 5 on the first factor. So you have to send much more to the individual, assuming that's possible. But at the same time, you have to be careful not to send too much to that individual, because also what's happening is that the overall effective tax rate is getting smaller. The more you take away from the spouse who's paying tax at 45%, and just note this tax doesn't include Medicare levy, so you lose 2%, doesn't count for anything on these guidelines. So you're taking away income that's taxed at 45% and giving it to the individual practitioner who's working their way up through the marginal tax rates and at the moment in the 37% tax bracket. So you're losing 8 cents on every dollar you shift from the spouse back to the individual. And on these figures, a split of 150,000 and 425,000, you seem to be in a sweet spot as it achieves an effective tax rate of 35%, and you keep that second risk factor score at 2. You can actually split the income a bit more to bring the individual practitioner over 180,000 and in the top marginal rate. You fully exhaust that lower marginal tax rate, and the effective tax rate actually drops to below 35% collectively, giving you a risk score of 3 for that second factor rather than 2 and putting you back in the amber zone. So there's definitely a lot of dynamics at play here in applying this risk framework and little traps that might not be obvious. Again, if the IPP and the spouse had other sources of income, it would be a lot easier to be considered low risk, as it might be just that you get an effective tax rate of over 40% due to these other sources of income, giving you a score of 1 or 2 on the effective tax rate, no matter what the split is. Now, just the last example I'll go through very quickly. Again, we've got $600,000 of total profits coming through the firm and the service trust, and let's say it's split 2/3, 1/3 between the practitioner and their spouse. So say $400,000, $200,000 split. So the other background fact here is that they jointly own rental properties and generate $100,000 of negative gearing losses that year. So this example highlights, I guess, the favourable way that the PCG lets you calculate the effective tax rate by letting you take the higher of the actual tax and the hypothetical tax that if such losses were ignored. So effectively allows you to calculate your tax, assuming taxable income was 400,000 and 200,000 rather than what it actually is 300,000 and 100,000. And under this hypothetical, you can get an effective tax rate over 35%, which puts you in the green zone despite really paying 21.43% tax on that $600,000 profit share that year. And this just shows, you know, let's say you couldn't take the higher of, you had to take the actual tax, you would be in the amber zone because you have that score of 5 on factor 2 rather than a much lower score of 2 using, you know, the greater of. So that is somewhat favourable for those who have losses in their own name. They can effectively ignore the fact that they're reducing the tax that year for these purposes. So conscious of time, just want to touch on a few things that this risk framework is not clear on. And we've been in discussion with the ATO around some of this, so hopefully we get some clarification. Now, the first is it's not clear whether you look at tax or accounting figures. For example, some years there may be large provisions of movement or movements in WIP balances, creating, you know, large timing differences. And it's not clear whether, say, for the third risk factor about commercial remuneration, you look at the actual profit share or share of taxable income. Do you, which one do you compare to your benchmark remuneration? So you think it's based on the accounting figure, because if my benchmark is X dollars and I receive X dollars in cash, well, what should it matter what the taxable income figure is? But again, it's not exactly clear. And what the ATO have told us is that at their end, what their risk engine is going to spit out is tax figures. They're not going to know the full story behind this. So using their sort of own risk assessment engine, they might come up with something, you know, different to what the practitioner might be aware of, and then that might, you know, lead to further queries, which is unfortunate. The second area of uncertainty relates to the retention of profits in companies. So the practice itself could be incorporated and may, you know, reinvest large amounts of profits. The practitioner may also distribute to corporate beneficiaries, but in later years receive frank distributions and pay top-up tax, or even in, you know, in the current year they receive frank distributions and pay top-up tax. And this obviously creates timing issues and issues of working out, well, you know, how much of the firm's profits were returned in that practitioner's name, own personal name that year. Because if it comes to a company, it might be hard to link back to the original, let's say, firm profits. So again, the ATO will just have a risk engine that looks at a snapshot at a point in time for an income year, and may not easily be able to pick up situations such as where frank distributions come out, let's say shortly after year end, and top-up tax is paid, but in that year you only have, let's say, 25% tax counted toward that effective tax rate factor. So again, if that leads to some further investigation from the ATO to understand things more fully, it kind of undermines the whole self-assessment system that's purported to be the case in the PCG. So, I mean, practitioners would ideally like to rely on the PCG to stay in the green zone without having to answer these extra questions from the ATO, because they're just not going to have all the data to fully make that assessment that the practitioner can make themselves. Now, the last area of uncertainty sort of relates to the use of losses for interposed entities. For corporates, this should be fairly straightforward. You just ignore the losses. It will be seen to be taxed at a flat rate, because you can assume that profit share is $1 for the company. Now, trusts are a bit more complicated, and based on our discussions with the tax office, we believe for fixed or unit trusts, you could effectively assume the gross amounts that were distributed to those fixed trusts flowed through to unit holders in their, you know, in their proportions, and you can work out effective tax rates based on that assumption. Now, for discretionary trusts, that becomes somewhat more problematic, as you may not know exactly where the extra income would have flowed to, or perhaps, do you base this on resolutions for that year if they were made, or maybe if none were made, do you look at patterns of prior year distributions, or do you assume maybe the trustee would pay tax at 45%, or you say, well, no, it's 0%, and this is just really an unknown, and with some suggestions to the ATO how this could be sort of communicated. So we're hopeful we can see some further guidance on this in the final product, but again, at the moment that's a big unknown, how to self-assess where deductions or losses in a discretionary trust somewhere in the chain absorb some of the profit share that comes through. So what's been done about the draft PCG? Well, there's also been a lot of interest by many professional bodies. We were involved with each of, chartered accountants, CPA, and the tax institutes, as well as some direct engagement with the tax office. And each of these made quite detailed submissions, which I believe are all publicly available. You can find on their websites. Broadly, they're all very unsupportive of the PCG. I don't think any of them agreed with the rationale at all. And some of the key themes that came out of these were highlighting the discriminatory treatment of certain classes of individuals as well as industries compared to others, questioning the legal basis for the shift in the ATO's view, highlighting misconceptions about what is income from personal exertion, and an outdated view about what principles of these firms actually do on a day-to-day basis. And that's actually touched on that a lot at the start of our presentation. Also expressed disappointment about an effective lack of a safe harbour and the high compliance costs imposed on practitioners of these firms under the PCG. And some of them also encourage, ATO just, run a test case already, stop, wielding a stick and actually, get some binding judicial authority so you can base the guidelines on law rather than sort of these vague benchmarks. Now, will anything fundamentally shift? My personal opinion is no, it's hard to see anything fundamentally changing, but we might see things tinkered around the edges, such as perhaps tweaking the scoring system based on various examples that were provided to the ATO where anomalous outcomes were identified, and also clarification of certain ambiguous items, such as we touched on the use of tax versus accounting figures and the effect of losses. Now, when will it be finalised? It sounded like they wanted to wrap it up, sooner rather than later, given the proposed 1 July start date. But the timeline for submissions was extended a few weeks. I think that closed April 16th, and we actually have a lot of submissions to consider. So, look, I suspect we'll be probably well into the new financial year, unfortunately, before we see a final product. But I'm willing to be, to see something, to be surprised and see something come out on this side of July 1. Just briefly, I just want to highlight that Pitcher Partners, we've developed a risk assessment tool. So it allows you to do this exercise fairly quickly just by inputting some data to sort of self-assess individual practitioners' risks based on distributions or proposed distributions, and that can help with year-end planning. So you can reach out to your usual Pitcher Partners representative or one of us to assist you with this if need be. And we'll obviously keep an eye out on any changes in the final PCG and update our model accordingly. Now, conscious of time, I'll leave it there for me. I'll pass back to Mark now, who's just going to talk about the next steps and wrap up our presentation.
Thanks, Leo. I think that the main messages for now is there's no change for the current financial year, the 21 year. Secondly is, can you get into the transitional rules? So you've got no change for 22 or 23. The third thing is to look at whether or not you need any structural change to how you're set up. In many cases, you won't. In some cases where let's say if I signed 60% of my partnership interest to a spouse, I might need to do some restructuring there, for example. I think the impact on salaried partners and fixed draw partners is a retention issue that needs to be looked at. And then otherwise, on what we know, it may be worthwhile modelling what the future outcomes will be. And typically, if you're at the low end of income, let's say 200,000 or less, or at the high end over 1.5 million or more, that's when using the scoring system, that's when you're typically most impacted by what's proposing. But what's been proposed. But I'll leave it there and hand over to Ash.
Thanks, Mark. We've got 2 questions that I think first one, or the 3 questions, but 2 are much the same. What if the effective tax rate is lower because of interest deductions? And the second one, if you had 200K of bank interest and received 20K on firm profits, is the tax rate 45% or 0 based on an average rate? And I think, Leo, you touched on really answering those 2 questions.
Yeah,
maybe
so
I might just...
Oh, sorry, go ahead.
Yeah, so I might just let you answer those 2.
Yeah, so effectively you can basically take a high effective tax rate, assume those deductions weren't there, you look at, let's say, ignore the fact that those reduce your taxable income and you'll calculate the effective tax rate based on what it would be, assuming you didn't have these, let's say they're negative gearing losses. So you can get a better result. On the second question, just that you might get a 45% effective tax rate on the $20,000 of firm profits, but you need to look at the effective tax rate collectively. So if there's only $20,000 of profits, then that's the effective tax rate. If there's $520,000 of profits, you got to work out, well, what tax was paid on the other 500,000, and then average it out totally. So it's not, we don't just look at the effective tax rate for the practitioner, it looks at the effective tax rate paid on the profits wherever they end up.
Yep. And the last question was, if we operate through a discretionary trust, what does an equity holder mean? So Mark, when we were talking about the gateways and equity, obviously with discretionary trust, you don't have an owner. I presume that's just beneficiaries.
Correct. So when they talk about an equity holder, they say that you've got to have full rights to participate in the voting, management and income of the firm. So on the voting and the management, I'll be looking at the trustee of the discretionary trust to see who the directors and the shareholders are, and who makes the decisions. And on the income of the firm, you'd be looking at the class of beneficiaries. And if you're within that class of, let's say, potential beneficiaries, and you have been participating in the income, I would have thought you've got as many rights as anyone else to participate in the income of the firm.
That does beg the question, if it's full rights, Mark, if you have, say, 2 partners or 5 partners who are the directors of the trustee company, but there's 40 or 50 partners, do you have full voting rights? Do you have to have every partner added as a director?
Correct. And I think, Ash, that's an issue for all sorts of practices, whether they're a discretionary trust, unit trust, partnership or company.
Yeah.
For example, in some of the larger practices, you'll have boards that'll make a lot of the decisions. And, it's a question about whether or not there's practically full voting rights or not.
Thanks, Mark. And we're a little bit over time, so I apologise for everyone who's hung on, which is the majority, which is wonderful. Thank you very much. As the guys have said, we've got a bit of time to plan for these things, but it's going to affect most of us. So please reach out to your Pitcher Partners representative, and we'll be very happy to help deal with either your practice or your personal sets of circumstances. Thanks very much for your time today. And if you've got other questions, again, please reach out to Mark, Leo, or myself, or any of your Pitcher Partners contacts. Thanks very much. Bye now.